You hear the name Warren Buffett and you think legend, right? But his method often gets treated like it's some kind of black box, a secret formula that nobody can crack. Well, it's really not. In this explainer, we're going to pull back the curtain on how Buffett actually thinks. And you'll see it's not a bunch of complicated rules, but a clear, rational, and frankly, common sense way of looking at business that anyone can get their head around. All right, let's get into it. So first things first, we've got to understand just how much of an outlier this guy really is. We're not talking about just another successful investor. Warren Buffett is a genuine statistical anomaly, someone who consistently and just massively beat the market for decade after decade. And when you look at the numbers, it's just staggering. I mean, look at this. From 1965 all the way to 2012, Berkshire Hathaway's compounded annual gain was more than double the S&P 500. We're talking 19.7% versus 9.4%. That isn't just winning a race, that's lapping the competition for almost 50 years. To put that in perspective, academics have a name for this, a 5 sigma event. It's something that has a 1 in 3.5 million chance of happening. His entire career just flies in the face of the popular academic theory that says you can't consistently beat the market. Statistically, a guy like Warren Buffett just shouldn't exist. But then, you have the man himself saying this: "What we do is not beyond anyone else's competence." So wait a minute. How can a 1 in 3.5 million long shot claim that anyone can do what he does? That apparent contradiction, well, that's exactly what we're going to unpack. Okay, so the secret, if you want to call it that, starts with this one huge mental shift. You see, for Buffett, all those flashing numbers on a screen, the ticker symbols, the daily ups and downs, that's all just noise. He's not buying stocks. He's buying pieces of actual living, breathing businesses. This big idea? It came straight from his mentor, the father of value investing, Benjamin Graham. And Buffett says these 9 words are the most important ever written about investing. It's the whole foundation. Think like you're buying the whole company, not just gambling on a stock price. Now, Buffett took this core idea from Graham, this margin of safety, 100%. You know, the idea of buying something for way less than it's really worth. But, and this is a huge but, he completely evolved the method he used to find that underlying value. And this shift in thinking is absolutely critical. See, Graham was famous for his cigar bot approach. He'd look for mediocre companies that were so dirt cheap, they were like finding a discarded cigar on the street with one last free puff left in it. But Buffett, thanks to a lot of influence from his partner Charlie Munger, shifted his focus. He started looking for wonderful, high-quality companies that he could buy at a fair price because he realized the real money was in owning great businesses that could compound their value for years and years. So, how does he find these wonderful companies? You might think he's got some super secret, complex algorithm, right? Nope. Instead, he runs every single potential investment through a really clear 4-part framework. You can think of it as 4 big questions he has to answer before he even thinks about writing a check. Each of these filters, business, management, financial, and market, they all build on each other. And together, they force him to look at a company from every possible angle, as if he were about to buy the entire operation outright, not just a handful of shares. So it all starts with the business itself. Is it simple? Can he actually understand how it makes money? And crucially, where it's likely to be in 10 or 20 years? This is his famous circle of competence. If he can't get his head around it, he just moves on. He stays away from industries that change at lightning speed because they're just too hard to predict. Next up, he looks at the people running the show. Are they smart about where they put the company's money? Do they own up to their mistakes? And here's a big one. Do they resist what Buffett calls the institutional imperative? You know, that lemming-like instinct for CEOs to just mindlessly copy whatever their competitors are doing, even when it's a terrible idea. He wants leaders who think for themselves. After that, he finally gets to the numbers, but not the numbers Wall Street obsesses over. He couldn't care less about quarterly earnings per share. What he wants to see is a history of high returns on the money invested in the business, without a mountain of debt. And he focuses on what he calls owner earnings, the real cold hard cash the business generates. And only then, after he's analyzed the business, the management, and the financials, only then does he finally even look at the stock price. The last filter is that classic principle from his mentor. Can he figure out what the business is truly worth, and can he buy it for a lot less? The price is the absolute last thing he considers, not the first. All right, so that's the theory. It sounds pretty straightforward, right? But what does it look like in the real world? Let's take a look at one of his most legendary investments, Coca-Cola, and see exactly how he put this 4-part checklist into action. Now, Buffett didn't just buy Coke because it's a famous brand. No way. He waited. He watched it go through a really rough patch in the 1970s. He didn't make his move until 1988, and that was after a new, incredibly rational CEO named Roberto Goizeta came in and started a massive turnaround, focusing like a laser on creating value for shareholders. Buffett saw a fantastic business that was finally being unlocked by brilliant management. And you could see it right in the numbers. This was the proof. Under the old management, the company's return on equity was decent, around 20%. But under Goizeta, it rocketed to over 30%. That was a blaring signal that the company's economic engine had been totally supercharged. And this right here was the real kicker. This was the ultimate test. For every single dollar that Goizeta kept in the business to reinvest, he created almost $5, $4.66 to be exact, in new market value for the owners. This wasn't just good management, it was proof positive that the business, the management, and the financials were all firing on all cylinders. So, these tenets, they're simple, they're powerful, they make a lot of sense. Which leads to the big question. If it's all so straightforward, why isn't everybody a billionaire investor? Well, because knowing the rules of the game isn't the secret. The real secret weapon, the thing that separates Buffett from everyone else, is psychological. His true advantage is this powerful combination of 3 things. First, it's behavioral. He stays completely rational when everyone else is panicking or getting greedy. Second, it's analytical. He's always focused on the value of the business, not the flicker of the stock price. And third, it's organizational. He literally built his company, Berkshire Hathaway, to be a fortress that can ignore short-term market craziness and think in decades. There's actually a term for why most of us can't do this. It's called myopic loss aversion. It's a fancy way of saying that the pain of losing $100 feels about 2 or 3 times worse than the pleasure of gaining $100. So when we check our portfolios every day, we're just constantly exposing ourselves to that pain, and it pushes us to make panicked, short-sighted decisions. And Buffett's solution to this problem is incredibly simple, but for most people, it's unbelievably hard to do. Patience. When he says his favorite holding period is forever, he's not just being cute. He is building a psychological wall against that very human tendency to panic. He sets himself up to ride out the waves of volatility that cause almost everyone else to sell at the absolute worst time. And that really is what it all boils down to. Buffett's method isn't just about finance. It's about temperament. It's about having the right mindset. So the real question his whole philosophy leaves us with is this. In a world that is screaming at us to do something, anything, right now, what is the real and profitable power of having the discipline to just sit there and do nothing at all?